Hey there, and welcome to today's Explainer. For business leaders, entrepreneurs, and investors, accounting is way more than just some boring routine compliance exercise. It's actually the ultimate strategic vocabulary. It's a highly dynamic communication system. So today, we're decoding the language of business. By the end of this Explainer, you're going to see financial accounting for what it truly is, an essential framework used to accurately translate and understand the economic story of literally any organization. Here's a quick roadmap of what we're covering today. First, the language of business. Second, who needs this information? Third, types of business entities. Fourth, your financial position. And finally, profit, loss, and equity. All right, let's kick things off with Section 1, the language of business. So, what exactly is accounting? Well, at its core, it is simply a vital communication system. It was created to keep a reliable record of the financial effects of business transactions. That's it. Its whole purpose is to capture events as they happen during the day-to-day grind of a business. It gives us a really structured way to turn chaotic daily activities into clear, readable financial reports, handing leaders the exact metrics they need to steer the ship. Picture a business like a giant raw apple. It's complex, it's organic, and there are a million things happening all at once, right? Sales, purchases, hiring, manufacturing, it's a lot. Accounting basically takes that overwhelming whole entity and neatly slices it up into structured, digestible financial reports. Each of those slices represents a specific financial statement, giving you a clear, isolated peek right inside the company's operational health. Now, processing all that raw information happens through a very specific, highly refined pipeline. Step 1 is to select data. But here's the catch. We only select data that has an actual economic impact. Why does that matter? Because it aggressively cuts through all the operational noise and focuses strictly on what affects the bottom line. If it doesn't move the financial needle, it literally doesn't make the cut. Step 2 is to process that data, which means meticulously recording, sorting, and summarizing it. And finally, step 3 is to produce information, which culminates in the actual financial statements. So raw, unfiltered data goes in, and powerful decision-making information comes right out. Moving right along to Section 2, who actually needs this information? The people who use this information generally fall into two totally distinct camps. On one side, we have internal users, which is basically management. Management is the team actually preparing these financial reports to use for day-to-day operations. But keep in mind, they generally aren't the ones providing the capital. On the flip side, we have our external users. These are your primary stakeholders. Think equity investors who hold an ownership stake or lenders who have real money on the line. They absolutely rely on this pristine accounting info to make massive economic decisions. We're talking about deciding whether to inject more capital, sell off their shares, or maybe underwrite a huge loan. Sure, there are other external users like the government or employees, but core financial reporting is primarily engineered for the folks providing the capital. Okay, up next is Section 3, types of business entities. So what is a business entity anyway? It's simply an organization that leverages economic resources with one primary goal in mind, maximizing profit. Out in the business landscape, these generally fall into 4 specific categories. You've got the sole proprietorship, where one single individual is running the whole show. Then there's the partnership, where 2 or more people join forces to share the risks and the rewards. We also have the closed corporation and, of course, the company. But here's the really cool part. Regardless of which legal structure an entrepreneur goes with, every single one of these entities has to speak the exact same fundamental accounting language to accurately communicate how they're doing to the outside world. Which brings us to Section 4, your financial position. Let's look at the Statement of Financial Position. Under international accounting standards, this is built on 3 foundational pillars. First, assets. Second, liabilities. And third, equity. When you integrate these 3 elements together, boom, you generate a clear, undeniable picture of exactly where a business stands financially at a split second in time. It is literally the ultimate snapshot of an organization's accumulated wealth and obligations. I like to think of assets as a super well-organized cabinet of resources. They are the absolute lifeblood of the operation. Assets are the specific economic resources controlled by the business as a result of past events. The entity strategically deploys these resources to chase that one overarching goal, maximizing profit. Whether we're talking about cash sitting in a high-yield account, heavy machinery operating on a warehouse floor, or even intellectual property just waiting to be monetized, these are the indispensable tools of the trade. And finally, let's dive into Section 5, profit, loss, and equity. Now, when we talk about performance, we can't just use vague concepts like making money.
Technical literacy in accounting demands total precision. Income is strictly defined as actual increases in your assets or decreases in your liabilities that result in an increase in equity. On the flip side, expenses aren't just spending money. They are the very real decreases in your assets or increases in your liabilities that result in a decrease in equity. It's an airtight, incredibly logical system. Every single time a transaction happens, it mathematically tugs at that exact balance of assets and liabilities.
When you compare these crucial financial statements side by side, you really have to notice the vital difference in timing. The statement of financial position is a static snapshot. It's locked to a very specific date, like December 31st. It reveals the exact balances of wealth and obligations frozen in that precise moment. But the statement of profit or loss, that's more like a dynamic video. It captures the continuous performance, all the income flowing in and the expenses flowing out, over an extended stretch of time, ultimately landing on a final profit or loss. They're two deeply different perspectives, but absolutely critical pieces of the whole communication system. Then, tying it all together, we have the Statement of Changes in Equity, which tracks exactly how wealth evolves over time. It establishes your baseline equity at the start of the year, adds any new capital the owners injected, subtracts any distributions paid out, and then folds in that net profit or loss from our dynamic performance video. It's basically the ultimate reconciler. It makes sure external users understand exactly how and why the owner's wealth transformed from day 1 all the way to day 365. Wow, we have covered some seriously vital ground today. We've talked about translating raw, chaotic business data into highly structured, actionable intelligence. Accounting truly is the language of business, and mastering its vocabulary unlocks a whole new level of strategic clarity for you. So, now that you understand the foundational grammar of assets, liabilities, income, and expenses, how will you use this newly decoded communication system to cultivate and measure your own economic decisions moving forward? It's something to think about. Thank you so much for joining me on this explainer, and I'll see you next time.